Welcome to the Bitcoin Tutor. Today's topic is Bitcoin mining. With so many new people coming into the crypto space right now, with the bull market in full swing, I think it's important to go back to some of the basics and have a chance to explain what this is all about. And looking at Bitcoin is always the best bet because it really is the gold of crypto. It really allows you to take a look at how everything is designed, and the idea of other cryptocurrencies, almost all of them have been modeled on Bitcoin. So let's take a look at Bitcoin mining and what it is. So first of all, why do they call it mining? Well, the idea was to be similar to the idea of gold mining or silver mining, where you're mining for ore in the deep mountains or in a deep tunnel. There's a similarity in the Bitcoin mining because what we're doing is we're mining Bitcoin. We're creating new Bitcoin, which is not a simple thing. It's not just a matter of creating some numbers on a ledger and that's that. No, it's a very complex process, and the idea is that every 10 minutes, new Bitcoins get created. And that's the way the Bitcoin network was created. So how does that work? So anyone can actually participate in this. Every computer that wants to participate simply loads the Bitcoin software and connects to the network, to the internet. And then these different computers called miners basically communicate, and they get informed of all the new transactions that have occurred over the last 10 minutes, and they process them in that new block, which occurs every 10 minutes. So you can see that it could take up to 10 minutes or so to have your transaction fully processed. So there are two main things that happen in mining. One is the creation of new Bitcoin, and two is the processing of transactions. And then finally, the last part is creating the block that becomes part of the blockchain. And the blockchain is the ledger, is the name for the ledger, which is basically a chain of blocks. And each block, again, represents 10 minutes of activity on the network. Okay, so that's the starting point. So where do we go from here? Well, what is that reward? When Bitcoin was first created, the reward was 50 Bitcoins. That was amazing. And today's prices, that would be quite a reward. But when Bitcoin first started, it wasn't traded publicly, and then eventually it sold for a penny, and then $1, and then on and on. And today, as you may know, at the end of 2024, Bitcoin is trading at over $70,000 per Bitcoin. So that's quite a difference. So every 4 years, there's something called a Bitcoin halving, which means that the reward of Bitcoins per block gets halved or cut in half. So the first 4 years of Bitcoin were 50. So the reward was 50 to participate. And those people who participated and held those are now millionaires and billionaires. 4 years later, it was cut in half to 25, and then to 12 and a half, and then to 6 and a quarter. And most recently, earlier in 2024, at the halving, the reward dropped to just over 3 Bitcoins. Now at $70,000 each, that's still a hefty reward of over $200,000 worth of Bitcoin every 10 minutes. So that's how much new wealth is being created in the Bitcoin market, or Bitcoin network. So as I mentioned, the other thing that happens is that transactions get processed. So miners make money from two different things, from the Bitcoins and from the transaction fees. And over time, with all the halvings, you can see that over time, the number of Bitcoins that get created will continue to reduce, but the transaction fees are intended to support the mining network so that people want to continue to do Bitcoin mining, which is critical to the Bitcoin environment, to the Bitcoin ecosystem. So how does mining work though? What do they do? So the idea is that they run a specific program, the Bitcoin software, and what that does is it does those first two things I mentioned, which it'll eventually create Bitcoins and it will process transactions, but it's a competition. So there's a certain prize that's trying to be won here, and the prize actually is the Bitcoin. Out of the thousands of computers, only one will win the block every 10 minutes. So you can imagine with thousands of computers, you may not win a block for months or ever. So what people have done so that people can work together and participate in this is that they have created pools. So there are mining pools, and a pool is simply the idea of many miners or many of these computers, maybe yours, maybe mine, maybe a company's, all come together and we work as a group. And there are many mining pools throughout the world and different countries. And what this does is, rather than try to strike it rich and try to get your 3 Bitcoins, which you may or may not get, rather it's better to make a little bit of money every week, because someone in your pool will likely be winning a few times a week. And then they split that reward based on the contribution of the computing power that you contribute to the pool. Now, the cost of these Bitcoin miners is quite high because the specialized hardware that's now required to do this. It used to be that any PC could do this, but now the difficulty of the algorithm is so high that you can't really compete. And the cost is pretty high because the computers are churning and running, so their CPUs are running full tilt. So they require a lot of power, and they require a lot of cooling if they're running this hard and this fast. They have to be in an air-conditioned room, or they have to be in a computer center. And that, in fact, is where most mining pools are based. They're based in some mining center somewhere. So it's a very interesting time with how this works now. Again, originally it was designed so anybody could mine it, but the difficulty of mining has increased. So let's talk about that. When Satoshi Nakamoto first invented Bitcoin, it's unclear, it's probably a group, so I'll say they had this understanding that over time more and more mining computers would be involved, and that they wanted to keep the mining secure and competitive. So to do that, they needed to add a difficulty factor. And what the difficulty factor does is try to keep blocks at 10 minutes apart. Because the way blocks are created is when someone solves the difficult mathematical game, basically. It's a mathematical equation they have to run until they get a specific pattern. And once that happens, without going into the details of that, once that happens, a new block is created. Now, as more and more computers join the Bitcoin network, that time shrinks because there's more and more computers involved. So rather than 10 minutes, it might drop to 9 minutes or 8 minutes. So every 2 weeks, the network recalibrates the difficulty. This was a brilliant consideration by the inventors of Bitcoin. So if it's too short, then at the 2-week interval, the algorithm gets a little harder. The answers get a little harder. And vice versa, if the blocks are taking too long, 11, 12 minutes, then at that next 2-week interval, the difficulty is made easier. And it's gone up and down in the history of Bitcoin, depending on mostly the price of Bitcoin. Because as price goes up, people want to be mining Bitcoin. And as the price goes down, some miners decide it's not worth the investment, so they back out. So this difficulty adjustment keeps the security and keeps the timing of the blocks very high. So that's another great benefit. So as I mentioned, anyone can participate in a pool, but you do have to make a substantial investment in equipment, usually starting, I would say, around $20,000 US or higher, to have a stake in a physical pool where you buy equipment and you store it in a data center, and you benefit from some percentage of the winnings or the earnings of that pool. So the interesting thing about all of this in the end is that there is no third party. There is no bank. There is no central party that has to approve all these transactions or anything like this. Because of the algorithm or the software actually controls the security, it controls the trust, it controls the way the monetary supply works for Bitcoin. So that is a huge advantage, where you're not dependent on let's say, a too big to fail bank, or a government that may be printing too much money and devaluing or debasing your own currency. And as we see around the world, there are many countries doing that. So over time, I would say we can expect the price of Bitcoin to continue to go up for another reason. In addition to the growing interest and the sort of limited amount that gets created, it's not just printed $1 trillion at a time. There's also a hard limit on the number of Bitcoins that will ever be created, and that is 21 million. And as you can see, if every 4 years the number of new Bitcoins gets halved, you can see over time it'll be halved to virtually zero. And that the only thing that will support the Bitcoin network at that time, or at that point, are transaction fees. So we can see that happening probably in the next 10 to 20 years. In fact, the creation of new Bitcoins will be virtually nothing by 2040. But most of the Bitcoins have been mined. So something around 19 million Bitcoins, more or less, have been already mined. So there's really only 2 million Bitcoins left to be mined. And some people estimate that 2 million or so Bitcoins have been lost forever because people lost their private keys and there's no way to restore them. So that's also another interesting consideration when you think about how many Bitcoins there are and how many Bitcoins there will ever be in the world. So many people, given all of these facts, think that Bitcoin will continue to rise over time, and that's a likely scenario. So if you'd like to know more about Bitcoin and mining and some of the basics about Bitcoin, we cover a lot of these topics on this channel, the Bitcoin Tutor. So I invite you to like, share, and subscribe. And if you have any comments, please leave them below the video. Have a great day and go Bitcoin.